Okay, thank you. First of all, I would like to thank you, the organizers, for including this paper into the program, and I'm happy to present here. This is a joint work with Scott Richard, Ivan Shaliastovich, and Amir Yaron. So today I'm going to be talking about how risky are the US corporate assets. There is huge literature that aims to understand what drives the asset prices and what explains the asset premium. And the typical approach in the literature has been to focus on the per-share investment strategy, where an investor buys one share of the aggregate stock market and holds it for forever. In such strategy, the payout to the investor would be the typical per-share cash distribution in the form of dividends. However, the modern financial markets present many other means through which the corporations can channel resources to and sometimes from investors. Corporations routinely issue and repurchase shares, which presents a negative and a positive payout to investors. Corporations also borrow through the corporate bonds, and as such, they can distribute funds to investors via the scheduled interest payments, but also through the issuance and repurchase of debt. What is the unifying feature of all these types of payouts is that they are available to the investors through the financial markets and can be easily achieved by investing and disinvesting into the equity in the corporate bonds, exactly as in a per-share strategy. So what we're going to do in this paper, we're going to deviate from this per-share approach in two ways. So first of all, we're going to consider an investor who's going to hold not just one share, but the entire supply of the capital. What it's going to mean in terms of the payouts to investor, that now they're going to include not only the cash distributions in the form of dividends for equity market and the coupon payments in case of the debt market, but also the payouts in the form of repurchases and issuances. And the second dimension we're going to deviate is we're going to bring in the debt side of the market. So while the equity measurements, the data sources are pretty standard to uncover the measure of the corporate assets coming from the debt side of the market, as well as payouts to investors, we're going to bring in this data source from Barclays. So the first question that arises, why should we even care about this aggregate investment strategy, as well as incorporated the debt side of the market? And when the investor holds the entire supply of the capital, he gets as close as possible to owning the firm through equity during the normal times and through debt in contingency of default or bankruptcy. Also, this aggregate investment strategy is most appropriate from the macroeconomic standpoint because it allows us to feature the transfer of resources from a representative agent into the corporate sector. And finally, what we find that accounting for these payouts in the form of issuances and repurchases, as well as bringing in this debt side of the market, going to affect both qualitatively and quantitatively the nature and magnitude of risks in the corporate sector. So let me just start with giving you a preview of the results, the set of the novel empirical findings that we get about this aggregate payout on the corporate assets to the investor who holds the entire supply of capital, both equity and debt. So remember, this total payout is going to be coupons, dividends, net of minus issuances of equity and debt, plus repurchases of equity and debt. So what we find is that after accounting for issuances and repurchases, often this total corporate asset payouts tend negative, meaning that there are periods when the corporations, rather than paying out cash to investors, they're channeling resources into the corporate sector. Second, after accounting for the net issuance, these total asset payouts have much higher standard deviations than the standard per share dividends. So what's going to happen that the net issuance is going to drive a lot of variation in this total payout to investors. Finally, we document that unlike very procyclical cash distributions, this total payout is going to be acyclical, both at the short run and the long run. What do I mean by acyclical? That they have very little cyclical correlation with the measurable fundamentals, like consumption or output growth. And this is going to be especially puzzling because when we look at the risk premium on a corporate assets, it is comparable in terms of magnitude to the equity premium. So we have high asset premium and no exposure to the growth risk, neither at the short run or a long run, in terms of the aggregate payouts. So the puzzle is where this risk is coming from. So to reconcile this evidence, these novel features of the data, we're going to develop a model, and we're going to show that this is exposure of the cash payout, this first component, to the growth risk of low frequency that's going to generate a sizable asset premium. But because this second component, net issuance, is very volatile, it's going to mask the exposure of the total payout to these low frequency growth risks. Obviously, this is an asset pricing paper that fits a huge strand of literature, but in the interest of time, I'm just going to focus on this most closely related literature. All these three papers, they also focus on the aggregate investment strategy and try to capture the payout that result from the change in the number of shares outstanding. The first two papers is going to focus purely on the equity market, while the paper by Lorraine and Yogo, they also bring in the debt, but unlike us, they're going to focus on the book value. But despite the fact that all these papers are looking at the aggregate investment strategy, the question that they are investigating is very different from what we focus in this paper. So the paper by Bensal, Yaron, and Lorraine and Yogo, what they are trying to understand is what moves the variation in the aggregate payout yield, whether this is a movement in discount rates or is it the movements in the expected cash flow growth. By contrast, this paper by Boudou, and I'm probably mispronouncing, Michele, Richardson, and Roberts, they are trying, sorry, Michael, I'll improve. They are looking at the return predictability when using the aggregate payout yield rather than the standard dividend yield, and also try to see whether this aggregate payout yield contains the information about the cross-section of expected returns. Unlike these papers, we're trying to see what is the nature of risk in the total payout to investors. So I'm going to start with giving you more details on this per share and the aggregate investment strategies, then walk you through the data and the empirical measurements, demonstrate all the empirical findings that I already gave you a preview, and then conclude basically with the model. So in the typical per share strategy, what happens at time t, an investor is going to buy a share of an asset at price pt, and between period t and t plus 1, he's going to earn a gross return, which we denote rt plus 1. So that next period, his total dollar payout going to be split between the capital gain as captured by price per share times t plus 1, plus this cash distribution per share. So just as a side note, I'm going to apply both for equity, debt, and asset, but I'm going to generally refer to an asset. But as I said, the focus in our strategy is going to be this aggregate strategy. So what's going to happen here, the investor is going to buy not just one share of an asset, but rather going to buy all outstanding shares of that asset. What is important to notice here that in both of the strategies, per share strategies and the aggregate strategy, the investor is investing in exactly the same underlying asset, which means that per dollar returns in both of the investment strategies are going to be exactly the same. But what's going to be different is going to be the total valuations as well as total payout. So the total valuation now going to be the price per share times t plus 1 times the number of shares at time t plus 1. And now I'm going to zoom in on what is this total payout and then to the investor when he buys the entire supply of capital. What I'm going to do, I'm just going to write this payout as the difference between those two elements and take the definition of return based on the per share strategy. And what one can easily show that we can represent this total payout DAT plus 1 as the difference between the aggregate cash distributions, so in case of equity it's dividends, minus this term, which we denote net issuance, and which is the difference between the, in case of equity issuance, minus repurchases. So that's I'm going to come back to all the time. Total payout is cash payouts minus this net issuance component. So the way to think about the repurchases is another form of for the corporate sector to pay out to investors, while the issuance is a form of channeling resources into the corporate sector. Okay, so here we have two markets, the equity and debt. So for the equity, everything is pretty standard, the CRIS monthly stock file, We're going to work at the individual firm level, calculate the payouts, and then aggregate across all corporations. For the debt data, we're going to mostly rely on the corporate bond indices from Barclays. And these indices are widely used throughout the financial industry because of their wide coverage. They provide the data, the indices, and the valuations on a daily basis, but we're going to take them only on the last trading date when the prices are hand-marked by the traders. And another nice feature of this data set is that they provide the total return decomposed into the coupon return and price return. So using those returns, we can recover the payouts to investors. Unfortunately, we don't have disaggregated at the individual firm level the data, so we wouldn't be able to separate repurchases and issuances, and we're going to work with the net issuance measure. We also complement this data with long-term debt due in 1 year from CompuStat, since it's emitted in Barclays, and also with a commercial paper. So when working with this aggregate measure of payouts, we're going to face a number of double counting concerns. So first of all, what we need to take care of, we need to take care of the cross-holdings. So it's a known fact that a lot of corporate bonds are directly held by the insurance companies. So if we were not to eliminate them from our trading strategy, we would be double counting. So without going into too much detail, unfortunately, we don't have the market data on the holdings of the corporate bonds by insurance companies, but we're going to construct a market proxy based on the book value, and as a first approximation, assume that the insurance companies hold the whole universe of the Barclays indices. We're also going to account for the equity cross-holdings and the cross-holdings of commercial paper. So our strategy is going to be not only look at the non-financial sector, we're going to be buying the total supply also of the financial sector, because we believe that banks, insurance companies, holding companies, they generate an important value added to the investor and to the economy, and as such, it's important to incorporate them into our trading strategy. But at the same time, we're going to exclude such investment vehicles as a mutual fund, closed-end funds, and ETFs, because we view them only as the means for investors to access the markets. Finally, what I want to stress that our trading strategy is going to focus on the corporate assets that are easily accessible to investors through the markets. And as such non-tradable claims as trade credits, policy liabilities, bank deposits, and bank loans, they're not going to be part of our trading strategy. We're not including them. But some of them, for example, bank loans, they're going to be indirectly accounted through the tradable assets. So let's think a little bit more about the bank loans. So because we are buying the equity and the corporate bonds of the banks, we're also buying the claims issued by the banks. So we're indirectly owing the payouts to the bank loans, even though we are not directly putting them into our measure. Okay, so now that I described the data, I'm going to start walking you through the empirical facts. So here I'm just showing you the aggregate market capitalization of the debt, which is this green line, the equity, which is this blue dashed line, and the sum of the two are going to be the market capitalization of the asset. So what you can see here is that equity is a substantially larger market. It has experienced a much bigger growth, and it also tends to be cyclical, as you can see in these two recent recessions. Overall, the aggregate market has grown from roughly 3.5 trillion to 34 trillion over the sample period between 1975 and 2017. Okay, now moving to the payouts. So again, I'm going to remind you that the total payout, which is in this graph, is this red line, going to be a difference between the cash payout, which is this blue line, and the net issuance, which is this green line over here. So what do we see from this picture? I mean, first of all, the cash payout is always positive. It is very smooth, and it is also cyclical. Probably it's too small of the scale. But compared to the smooth dividends, what we see that the net issuance is going to fluctuate a lot. So by no surprise, because total payout is just the difference between the two, the second component, this green line, is going to drive a lot of variation in the total asset payouts. Another thing that I want to point your attention is that there are periods when this total asset payout turns negative. So what's it going to mean? First of all, it's going to be challenging to describe the data because we're used to work with a stationary series, and the typical approach that we apply would just calculate the log growth rates and work with those log growth rates. They're not going to work any longer because our total payout over here would be negative. So what we propose in this paper is this alternative measure, which is the level change in the payout scaled by consumption growth. So what we can show that for positive payouts, actually this measure is approximately proportional to the standard log growth rate up to a constant. So what this payout measure is meant to capture is the fluctuations in the payout growth. And another useful feature of this measure is that it's going to be additive. So think about the total payout. It's the difference between cash payout and net issuance. So the growth in the total payout is going to be the sum of the growth in the cash payout minus the growth in the net issuance. So from now on, any properties I'm going to show you are going to be based on this growth measure. For the consumption, we're going to continue the standard log growth consumption. Okay. So here we have, three components of the payout: cash payouts, net issuance, total payouts, and three markets: equity, debt, and asset. So the first takeaway from here is that if we look at the net issuance, and let's focus on the asset net issuance, and compare its volatility to the corresponding cash payout, we see that it's substantially much higher. It's almost 10 times bigger. So by no surprise, this net issuance is going to drive a lot of variation in the total payouts. So when we look at the total payouts, they're as much volatile as the net issuance. The second takeaway is, if we look at the correlation between the asset payout and the two components, the equity and debt, we see that a lot of variation is also going to come from the debt side of the market. Okay. The next big question is, what is the risk in these payouts? And we're going to start with a very simple measure of risk, the business cycle risk. So this table, I'm going to report just the contemporaneous correlation between the consumption growth and the different measures of the payout. And let me walk you through since most of the interest is the asset payout, let me start with this line. So what we see, if we look at the cash payouts, they're going to be strongly procyclical. But then, if we look at the net issuance, they are actually acyclical, statistically insignificant from zero. But remember, because this net issuance is very volatile, it's going to drive a lot of variation in the total payout. So by the time we aggregate those two, we get to the total payout that is marginally procyclical. So this adjustment is going to happen in two directions. So I could have walked you through the top line. What you see that net issuance is going to significantly reduce procyclicality of cash payout, but by the time we incorporate the debt, it drops even further. Okay. Now I'm going to step away from the growth risk at the short duration and move to the low frequency growth risks. So how I'm going to measure it, I'm going to compute these multi-horizon correlations between the changes in payouts and the consumption growth. And what I'm going to do with these correlation coefficients, I'm going to plot them against the horizon. And again, this is going to apply for three payouts: cash, net issue, and total payout, and then equity, debt, and asset. So you're going to see a 3x3 panel. So probably the scale is too small, but these blue lines are effectively this correlation coefficient plotted against the horizon, which is varying between 0 quarters to 20 quarters. So what we see here is that cash asset payout is going to be strongly procyclical at all horizons, at short and the long run. And this is going to come from combining the equity and debt. So if you look at the equity, it's more procyclical at the short horizon compared to the debt side of the market. But then when we go to the longer duration, we see the flip pattern. But by the time we combine the two cash payouts, we get a cash payout and assets, which is strongly procyclical at all horizons. Now, if we look at the net issuance, and again, I'm going to start with the asset net issuance, you see that it's statistically insignificant from 0 at any horizon. And again, this is a combination of the equity and debt, where equity net issuance was mildly contracyclical and the debt net issuance was mildly procyclical. But again, what I want to point out, this net issuance is very volatile, so it's going to drive a lot of variation in the total asset payout. So by the time we aggregate the cash payouts and net issuance, we're going to get to the total payout. They're going to look very much like net issuance. It's going to be acyclical, both at the short run and the long run. Okay. Now that I described the risk properties of the payouts, I want to show you what are the asset returns. And the asset returns here are just going to be the weighted average between the equity return and the debt returns. The debt returns are smaller and less volatile, but because equity is the predominant market of the two, we're going to see that the asset return is going to be very much like equity. And you can also see it in this very high correlation with the asset returns. So what we see is that aggregate total payouts are not exposed to the growth risk of any duration, but at the same time, we see a Sharpe ratio on the asset of the order of magnitude as the equity Sharpe ratio. Further, if we do the same analysis of exposure of the returns to the growth risks, we would see and compute this multi-horizon correlation coefficients. We indeed see that asset returns, which is a combination of equity and debt, is risky, both at short run and at long run. And this is puzzling, given that I've shown you that the aggregate total payouts are acyclical. So just to recap, we have total payouts that are very volatile because of the net issuance. They can turn negative. They're acyclical. But at the same time, the return on the corporate assets is of the same order of magnitude as the equity return. So to reconcile this evidence, we're going to claim that this is the exposure of the cash component to the low-frequency growth risks that are going to generate a sizable asset premium. But because net issuance is very volatile series, it's very dominant and going to mask this exposure to the low-frequency growth risks. So we perform an extensive set of robustness checks and extensions. And I just want to quickly talk about this one because I find it very interesting. So we got to thinking about why do we see this net issuance being acyclical. So unfortunately for the bond data, we can't decompose it into issuances and repurchases, but for the equity we can. So what we see is that both issuance and repurchases are strongly pro-cyclical. But by the time we aggregate the two, they're going to kind of wash out each other. So our conjecture is that there is two sets of the firms, one with the good investment opportunities, who tend to issue in good times to fund those profitable opportunities. But there could be also other firms that don't have good investment opportunities, but in good times, when their earnings are high, are just distributing the cash to investors through repurchases. And the rest is just in the paper, and I'm going to step to the model. So the model is going to be very familiar, so I'm going to go very quickly over here. It's going to be a standard discrete time consumption-based economy. We're going to have a rep investor with Epstein-Dean preferences. We're going to follow this paper by Bansal and Yaron in modeling the consumption dynamics. There are going to be a persistent component, which is going to define the conditional expectation of consumption growth, but also there are going to be this time-varying volatility of the fundamental shocks. So what we are left to model is the dynamics of the payouts. And I want to point out that we're not going to model separately equity and debt. We're going to focus only on the lower panel, on the asset. But what we're going to model separately is going to be this cash payout and net issuance. So starting with the cash payout, we're going to model them being co-integrated in locks with consumption level. And this co-integration residual, which we denote as ST, going to be stationary, very persistent, and importantly, to capture the features of the data, is going to be exposed to the low-frequency growth risks. And because cash payout is just one component of the total payout, if we hold everything else equal, meaning that one component of the total payout is exposed to the low-frequency growth risk, it means that the total payout is exposed as well. Now, moving to the net issuance, here is a little bit of challenge with the negativity because net issuance occasionally tends negative. So what we're going to do, rather than modeling net issuance directly, we're going to adjust in the following way. So we're going to add the consumption level. So this adjusted net issuance is both economically and well supported in the data going to be always positive. Why? Because so here the only negative term in this expression is the repurchases. And the repurchases is just one form of the payout to investors, along with the cash distributions, coupon payments, wages that the investor are going to use to fund its consumption. So it should be economically smaller than the consumption level. Now we're going to take this adjusted net issuance and model it being co-integrated with the consumption level. But unlike the cash payout, it's not going to be directly exposed to the low-frequency growth risk. We're going to model it being IID. But to capture the data, we're going to calibrate this parameter varph to be substantially bigger than this parameter over here, varph, to capture the fact that the net issuance is 10 times more volatile than the cash payout. And I'm not going to go into the model solution because it's pretty standard. The only difference that I want to stress out, because the total payouts are negative, we can't apply the standard Campbell-Shiller log linearization of the return. So we would need to use the same technique to adjust the net issuance and propose a new log linearization. OK, so first I want to walk you through the moments that we are targeting when choosing the parameters, and then I'm going to show you the moments that we didn't. So what we capture with the cash payouts, that they are relatively less volatile than the net issuance, that they are strongly procyclical contemporaneously, and by no surprise, we don't have any negative cash payouts. They are always positive. Then we have the second component of the asset total payout, that's net issuance. We do capture that they are very volatile as compared to the cash payout. They're effectively acyclical, and they occasionally tend negative. So by no surprise, because we targeted the moments of the cash payout and the net issuance, because the total payout is just the difference between the two, we're automatically going to get the properties of the total payout. We're going to get that it's very volatile, it's effectively acyclical, and there are periods when it tends negative. At the same time, while capturing this total payouts being acyclical, we do get a large asset return, and we do match its volatility. So this was targeted. What hasn't been targeted is this lower panel that I've shown you, the exposure of the payouts to the growth risks of different duration. So what I'm showing here, let's focus for now on the cash payout, is in the blue we have the data. So this is this multi-horizon correlations between the payout growth and the consumption growth. And the model implied correlations, which is this green dashed line. So what we have here, both in the data and in the model, it is the exposure of the cash payout to the low-frequency growth risk that's going to generate a sizable asset return. But because we have the second component, this net issuance, that is very volatile and cyclical, we model it to be IID, we're going to get a total payout that's going to resemble very much the net issuance. At the same time, when we look at the exposure of the returns to the growth risk, we do match it pretty well. OK, so just to conclude, what do we have? We we measure this aggregate payouts to investor who holds the entire supply of equity and debt. This total payout is going to incorporate not only the cash distributions, but also payouts in form of issuances and repurchases. Once we do that, once we account for this net issuances, we get total asset payouts that sometimes tend negative because the corporations are raising capital from investors. We get a payout that is substantially more volatile than the typical cash distributions. And it's also going to be acyclical, both at the short run and the long run. But at the same time, we do get the risk premium on the corporate assets that is of order magnitude as the equity premium. And we developed this economic model that puts together these puzzling features of the data and shows that this is exposure of this first component of this cash payout to the low frequency growth risks that are going to generate a sizable asset premium. Thank you.